We have the Federal Reserve just came out yesterday, and they came out and told us that they're not raising rates, and then they went on this whole spiel of stuff. So let's get over to exactly what they said in yesterday's news conference. So what you're seeing right here is the actual transcripts that the Federal Reserve said or read off of in yesterday's newscast. So what I want you to show you guys is there's not really much that changed in the verbiage here. But then afterwards, the Federal Reserve came out and said, guys, we're going to keep rates longer for higher, and we're going to change even the dot plot. Okay, I don't take a lot of credence in that. Why? Well, they change the dot plot every 4 months. So yes, I use it as an analysis. It hasn't been updated yet. But going back to 2021, and I've spoken about this several times, is they told us in 2021 they have no expectations to raise rates until at least minimally 2023 and 2024. Well, coming into the end of 2021, that was thrown out with the bathwater, and they started driving up rates 11 times over, I think it was 13 meetings. So we really can't look at the projections they're saying, because it's like this. When I was a kid, my parents went away to Cleveland one time, and me and my brother, we knew it a week ahead of time, and so we planned a huge party, okay? The analysis behind this is that they would have never told us that they were going out of town. We couldn't plan that party. So what the Federal Reserve is doing right now is they're saying, okay, we're not going to reduce rates. We might even increase those rates. They're basically trying to advise the market. Now, they're not lying to the markets, because they keep saying it's data dependent. It's data dependent. But they keep sitting on the sidelines because they know every time they come out and say, okay, it looks like we're at the target rate where we want to be and inflation's coming in check. It's like my parents telling me a week ahead of time, guys, we're going out of town for the weekend, so have fun. And that was a wrong thing to do. So I hope you get my analysis there. So if you go through this in detail, there's really not much here to really get from the bone on this thing. So what we want to look at is the Federal Reserve declined to raise rates, but pointed to rates staying higher for longer. So what I did is I went out and I looked at the dot plot. It hasn't been updated yet, but the next meeting is now about a 60-40 chance that they might raise interest rates. I'm still very skeptical of that, because I continue to say that inflation is coming down. However, in this report, we're going to go over how more and more people are making more and more money, and dramatically more money. And I'm going to show you that here in a second. That's really going to throw a curveball to all this that everybody's doing at this point. But what I want to show you guys right there here is the Federal Reserve held rates steady. But here's another thing that people don't usually talk about. In addition to holding rates at a relatively high level, the Fed has continued to reduce its bond holdings, a process that has cut the central bank's balance sheets by $815 billion. So let me just give you a little bit of education on what happened during the pandemic. The Federal Reserve, was stepping into the market and buying up mortgage-backed security bonds and a lot of other bonds, treasuries and everything else, but they were buying up mortgage bonds. As you know from this channel, the education that we give you on this channel is the price of the bond goes up, the yields come down. So when somebody's buying, $4 billion or $40 billion a month in mortgage-backed securities like the Fed was doing, they were jacking up the rates artificially because there was huge demand, and that demand was from the Fed, jacking up the prices artificially, driving down rates to the lowest levels we've ever seen in history. Well, now not only are they not buying them, they're selling them, adding more pressure. So we have basically not a lot of investors buying mortgage-backed bonds anyways. And then we have the Federal Reserve dumping their bonds, like they just said in here. So that is artificially driving down prices, and rates are skyrocketing. That's what we're seeing in today's market. Okay, so what I want to show you guys right through here is how much bond holdings the Federal Reserve has. And this is just with mortgages. You see over through this corner here, it's Fannie Mae, and Ginnie Mae. So those are mortgage, basically bonds out there. Their holdings back pre-pandemic were right here. They've doubled. And there are also selling some of this stuff. So they've doubled it, and that's where I'm saying they bought up all these mortgage bonds and artificially, brought up the prices and down the yields. Okay, so here's my fear though. We have kind of a counterintuitive thing going on right now. We have UAW, they want a 40% increase. Okay, so why is the Fed doing all this? Well, they're saying the economy is too robust. People have way too much money and they're spending it. So at the beginning of the video, I said, okay, if you got $100,000, what would you do with it? Well, if you said, okay, put it in a CD or money market because rates are as high as they've been in a long, long time and live off that as investments, ding, ding, you win. Probably 99% of you said, well, I'd take a trip, pay off my credit cards, put a little bit of money in savings, and then just maybe buy a new TV, buy a car, buy a this and buy a that. Do you get my point? Okay, so not only do we have the UAW workers, and I'm not bashing UAW workers. I'm just saying right now people are demanding more pay. So we don't even just have those. We also have pilots, and we have other unions right now. Pilots got a 21% increase. They're expecting a 40% increase by 2027. So do you get my point? There's people getting more and more money. Now, the same thing happened during the pandemic when people didn't have to pay their mortgages and didn't have to pay on their student loans. They had that excess money, like we show all the time on the consumer disposable income charts. They had all this money and they're spending it. So again, going back to what would you do with $100,000? Okay, so that's that point that I wanted to make. So now we have the dot plot. This is where everybody's starting to focus right now, saying, well, the Federal Reserve, they're coming out now saying that they're not going to raise or keep rates low or drive rates down in 2024. They're actually going to keep it steady. So the dot plot has not been updated yet, so I'll continue to watch this so we can monitor that. So let's get over to the economic news that we have today. Other than what the Federal Reserve came out and said, is there anything else that should be maybe shaking the markets today? We have crude oil inventories. They're down and they're all over the map. So I really don't put a lot of credence in this. Oh, I'm sorry, folks. We are in Thursday. Initial jobless claims. My bad. I was going through the last thing. I was like, I think I went over that yesterday. Initial jobless claims. This is also freaking the Fed out. There was 221,000 people that filed for the first time claims at the last reading. They're expecting that to go up. Now, unemployment, remember, they want unemployment to go up. They're expecting it to go to 225. It actually plummeted down to 201. This is a bad signal for the Fed, but it's a good signal for me and you because it's saying the economy's okay. And as you can see, people are getting raises and everything else. The Philly Fed Manufacturing Index has plummeted. So this is giving us forward guidance on what's going on with manufacturing. Manufacturing is diving. Okay, so what we're having right now is, I'm saying the economy is really retracting. And I have a lot of people or a lot of friends of mine in the financial sectors, in manufacturing, in shipping, in trucking, in logistics, and they're all like, we're just treading water right now. We're not making any major gains. We're just trying to hold the levels that we have right now. That's not a good signal for the economy, but I'm still not a proponent that we're going to see a recession. So my contention on all this is employment numbers are going to stay steady because we also have a ton of stimulus money still out there. There's over $90 billion in stimulus money still has not been spent. Again, we go back to what I asked you at the beginning of this video. If you had a bunch of money, what would you do with it? Well, governments, when the federal government gives state and local governments a bunch of money, they have usually a time duration to spend that. This time they don't in a lot of cases. So they're sitting on this money, but they're going to spend it because if they don't, they have to send it back to the federal government. It's like you getting a $100,000 check from your employer saying, okay, spend as much as you want. And if you don't spend any of it, send me the money that you haven't spent back. What are you going to do? You're going to spend it all. Okay, so that's what the states are going to do. So there's kind of an oxymoron going right now. We have the government and all entities giving out more and more monies. And that's why I also say I'm glad, and I'm probably going to tick a lot of people off out there, I'm glad they didn't do the student loan forgiveness plan. They have a lot of systems set up for that. If you're low income, middle income, please reach out to your student loan company that's servicing that. Ask them what programs they have to help you. There are a ton of programs out there. But just to forgive that debt, it's not good for the person, well, kind of, and it's not good for our society. Okay, because that pumps that much more money into it. So another thing that the Federal Reserve didn't say, and nobody asked him this question, is now that student loan debt is kicked back in, how much is that going to take out of our economy? I did a video the other day. It's in the tune of $20 billion a month that people are going to have to now spend on student loan debt and not buying stuff. Okay, so all these dynamics are kind of just pulling against each other, and I'm still not a proponent. The Federal Reserve, I don't think is going to raise rates because the data that's coming in that they keep telling us about, that they're data dependent, is starting to crack at the surfaces like you see right here in the manufacturing indexes. Okay, so that's what we have right there. Next piece of the puzzle are home prices. Now, a lot of you guys ask me and continue to ask, Dan, what's going to go on with home prices? Guys, I really don't know, but Zillow and a lot of analysts are saying, we're not really going to see a crash. We shouldn't see a crash. Why? There's just no inventory, folks. And I'm not kidding. There's tons of data out there. A lot of people say, well, that's false narrative. It is not false narrative. There is no houses out there for sale. The only houses out there for sale are new construction and basically people that kind of have to sell the house, but they have equity. So are they forced to sell the house at a rock bottom or giveaway price? No, they can sit there and sit on the sidelines and say, okay, if you want to buy my house, here's the price that I'm asking for it. I had a person right now that are working on trying to buy this person's house. They've been working on it for about 5 months. And it's a unique home, but the person couldn't sell it. And I have a buyer that really wants it. And we've been working and going back and forth with that. So it just gives you a little bit of complex of what's going on in our society right now. So with all this data coming out, what in the heck's the bond market's doing? It's all over the map today, folks. So what I watch on a daily basis is right through here. This is the MBS market. Remember when I showed you this chart of how much the Federal Reserve holds in mortgage bonds? Well, it's right here. This is the mortgage bonds that they hold. This is called an MBS. Okay, right through here, I follow the MBS market. Okay, why? Well, because the yield on this bond is the biggest component of your mortgage rate. Okay, so what we focus in on is right here, the price of the bond. The price down today is down 33 ticks. What did I say at the beginning of the video? If the price goes down, yields go up. There's a yin yang or a reverse effect there. So this is probably going to equate out to about an 1/8 increase in rates. Where did they end yesterday? They ended right here. Here's where rates are last night based on Mortgage News Daily. It's right over there. The analysis of these rates are this. This is a first-time home buyer buying a primary home, and it's a single-family home. That's the 3 criteria. Now, their credit and other pieces of this, they have a 740 credit score, and they're putting down 20%. Now, you don't need to put down 20%, folks. Most of our buyers, if you're a first-time home buyer, you're usually putting down about 3%. If you're a repeat buyer, you might be at the tune of 5%. So very rarely do we have somebody with 20% down. But if you do, these are your rates. If you'd like to find out exactly what kind of rate you qualify for, or what can you even qualify for, the only thing I ask you to do is please don't disqualify yourself. Please reach out to us. We would love to help you. How do we do that? Well, first off, I'm a mortgage advisor licensed in all 50 states as well as Puerto Rico, so I can help anybody out there. So if you're out there and you're like, hey, Dan, I'd really love your help. First thing I want to say is if you already got a quote, please upload that quote right here at the loan estimate. We're going to analyze that quote because we're set up with over 70 different banks, credit unions, and mortgage companies to analyze, what you're getting out there, because we can scan all 70 of those companies. We can offer their programs and their rates to you guys. So the next thing is if you're like, okay, Dan, I need to apply. Well, click the apply now button. What it's going to do is something unique. You're going to answer a few questions, and then based on how those questions you answered those questions, you're going to be routed to a specialist on my team that specializes in exactly what you're looking for. But if you're out there and you're saying, Dan, can I just call somebody or email you my question? Sure. Scroll down to the bottom of my website and you can give us a call right here, 844-775-5626, or shoot me an email. This is my personal email and I will reply to you, I promise, at dan@therateupdate.com. So thank you so much for watching, guys. God bless. And if you haven't subscribed yet, please do. And the tag is down below. Have a fantastic day. See you tomorrow. Bye-bye.